video, I'm going to go over amateur beginner trader over market maker perspective. So what the bank see over what a retail trader sees or a beginner trader sees. So we're looking at the 1 hour on Euro USD. So we have price come up, and most traders would think, okay, it's a bullish trend. It's going to break because we have this huge bullish candle. However, this is why I talk about major zones and key zones, is because of the fact that you want to focus on pure price action first. So candlestick analysis is good in regards to knowing what the candle is doing, but however, it all comes down to what price the candlesticks are at. So just because you see a large bullish candle doesn't mean that it's going to keep going up. So what matters is looking at price and looking at that key zone. Okay, so we come up to resistance. If we look on lower time frames, we can get this confirmation. So we have an M pattern forming, and we also have a double top right here. Okay, so when we're looking back at this, we can see that the market is about to reverse. So most amateur traders would honestly buy after this, or they would wait until this bullish candle closed. Then they would buy right here, have their stop loss. I don't even know where, because I would never buy in here, but let's say they have a stop loss right here, and then their target is, I don't know, wherever they're thinking. And what ends up happening is they end up getting 15 pips. Then the market starts ranging, makes a double top, and reverses. Okay? So that's what a beginner trader would kind of do in this situation. So what ends up happening is the market corrects, makes a correction back up, and then keeps dropping. Because realistically, we are in a downtrend. But again, beginner traders would think, okay, we're in an uptrend, price is going to break up. But however, they're not looking left of structure to seeing that it's being tested. And again, this is just showing you the difference between what the market makers see and what an amateur trader sees. So that's what I'm talking about in this video. So what ends up happening is the market impulses again, makes a correction, and hits the low. Okay? So what a normal trader would think is that, remember, 95% of people, 90 to 95% of people fail in trading, okay? Because they're focusing on the basics and focusing on all the free stuff online and stuff like that. So they don't really know exactly how it all works. And I mean, if you're a beginner, you're not going to know all this stuff right away. So this is normal, but I'm just showing you how to avoid that situation. So what ends up happening is the market makes an impulse, corrects, respects, and drops to the low, okay? So again, most people in the market will say, okay, well, there is this strong bearish close, I'm going to sell right here. And what ends up happening is it respects structure, it respects this certain price, and then goes back up, okay? So then it respects this area. This candle comes up and people think, oh, okay, it's gonna break to this high. So what ends up happening is they just buy instead of waiting for confirmation, and then it wicks about 11 pips and then reverses, okay? And then they're in a loss. So these are the types of things you want to avoid. This is why I always stress about like taking entries off certain structure, because you don't want to focus on just candlestick analysis. It's all structure, it's all key zones. So what ends up happening is it reverses. So this candle closes, people say, oh, okay, it's gonna sell, they start selling, then it reverses, closes above structure, and then goes above this minor resistance. Okay, so then it comes down, ranges above, tests, and then continues high. Then the amateur trader would think, oh, okay, it's a huge bullish candle, it closed above structure, it's going to go higher, and then what ends up happening, there's no retest, it closes below, then comes up, wicks, this candle body closes and completely drops. Okay, so these are the reasons why you need to really, really focus on structure and understand. So what ends up happening, we find support in this area. So right here. Okay, so we find support in this area, price starts to reverse, and then eventually price breaks out to the 1.13350 area right here. Okay, so since it rejected once, twice, people would think, okay, it's going to reject a third time and drop. However, what ends up happening is price will eventually break out of this zone and go back to the major zone where this is the high. Okay, so that's exactly what it's doing. So we have a major low and we have a major high. So what ends up happening is it breaks, tests, and then continues up. So people would have their sell here without any confirmation. They would just think, oh, okay, it faked out here, rejected here, it's gonna go down. So instead of waiting for price to play out, you're just guessing, you're just jumping in because it rejected here and here. But it's showing you exactly that it's breaking, testing the structure, the candlestick bodies are closing above, and then it goes and tests that high. So it's really, really important that you make sure you have extra confirmation before taking that sell. You don't want to just take it because you see structure on the left. Eventually this will break to that major high. Okay, so let me just explain how this looks in a market maker way, so the bank's way. Okay, so what ends up happening is the trend is bullish, so traders are thinking, so the trend is bearish right here, but let's just say on the 1 hour that it's bullish right here. So people think it is bullish, it's going to go up to the high. Okay, so right here on the 1 hour it's bullish. Okay, so people will think that since this is the high, that this will continue up. Okay, so they think it's going to go like this. Okay, so the second thing is the market makers push price down to convince sellers and they absorb their orders. So price arrives at a key level and then reverses. So arrives here at a key zone and then comes back up for a test and then continues down. So then what ends up happening is the market makers push price up to convince traders to go long and then sell against it, which causes buying pressure to absorb the orders, and then price falls again. So what that means is they push it up thinking that price is going to go long, and then they push it down again. So it's just a repetitive cycle. And then what ends up happening is at the end of it, market makers push price down for the second time to convince traders that structure will break orders, and then the orders all get absorbed and the market makers have all the orders they need to, so then price ends up breaking structure. Okay, so that's how they look at it as a bank way. So that makes a lot more sense than just focusing on candlestick analysis, right? So the zones are everything and price is everything. Where you're taking that entry and what price you're taking it at is super, super important. So I just wanted to show you the difference between what an amateur trader would think and what the banks are actually doing. Okay, so it's really, really important that you're trading with the bank side and not trading just based off a candlestick. Okay. If you guys have any questions at all about this, let me know. But again, always follow structure.